If you're watching this video, you are most likely interested in getting the private mortgage insurance or PMI removed off of your loan. I'm going to show you how to do that today and the steps and criteria necessary to remove that. We're going to be talking today about conventional loans. I'll talk about FHA in another video. But on a conventional loan, when you purchase a home, if you have less than 20% down payment, you're required to have some form of PMI or private mortgage insurance. This is a protection to the lender that you get to pay for as part of your monthly payments. And once you achieve a certain point in your loan where you have enough equity, you're able to request and have that removed off your loan. So let's look at how to do that. By the way, my name's Miles Pitcher. I own Superior Lending. So the first way we're going to look at this is based off the original purchase price value of the home. You bought a home for $600,000, it appraised for $600,000. You did 5% down, and your original loan started at $570,000. So as you have been going along, the point at which you can request the lender to remove your PMI is when you've paid down to 80% of the original appraised value. 80% of the original appraised value, which would be, if you bought for $600,000, it would be $480,000. So in closings with my clients, I circle a number and write it down there, and it says, when you pay your loan down to $480,000, you can request the servicer to remove your mortgage insurance. And they will do that. You'd have to call them up. It is a borrower request to do that. The lender will automatically remove the PMI once your loan balance reaches 78% of the original appraised value. So if $600,000 was our original appraisal, you'd have to pay down to $468,000. And then that cancellation of the PMI happens automatically. So that's all based off of original appraisal and where your current loan balance is. What happens if the home is appreciated significantly and you want to tell the lender and say, hey, look, my home has shot up in value, plus I've paid it down a little bit. I want my PMI removed. This is the more common situation, and let me walk you through how we handle that. So in this one, let's remember that you do have to get your loan balance down to where you have at least 20 to 25% equity in the home. Or with the added appreciation, you show that much equity. Here's a few key points. Remember that you will have had that loan for 2 years. Okay? If you had the loan from anywhere from 2 to 5 years, you're going to have to show an appraisal, and it will be ordered through the lender that appraisal will show that you have at least 25% equity in the home. If you do, then they will remove the PMI. You'll hear appraisal or what they call a BPO, broker's professional opinion. It's basically like an appraisal. Now, if you've been in the home greater than 5 years and had that loan for greater than 5 years, then that's where you only have to have 20% equity in there. Okay. You also have to have a situation where you're current on your mortgage. You haven't had any 30-day lates in the last 12 months and no 60-day lates in the last 24 months. And like I mentioned, there will be an appraisal required. So let me walk you through a scenario. My client bought a home for $600,000 in February of 2021. 5% down payment. Loan balance started at $570,000. They are paying PMI. Currently, March of 2023, their loan balance is $500,000. Okay, their home has increased in value since they bought it in February of 2021 to $675,000. So let's check and see if this fits and would work for removing the PMI. Have they had the loan for over 2 years? Yes, they have. February 2021 is when they bought it and got the loan. We're now March of 2023. Is the loan to value 75% or lower, meaning they have 25% or more equity in the home? Well, the appraisal comes back and it's at $675,000. Yeah, they do. They absolutely do. My clients have been perfect on their payments. They haven't been late in any which way. So yes, we check that box. So they can call up the servicer and say, hey, we believe we can get our PMI removed. We've been in the loan longer for 2 years, and our home's appreciated. We should have at least 25% equity in the home. Remember that if they had been in there over 5 years, then it's only 20% equity. Now, there's another exception or scenario here that I want to walk you through. Let's say the client bought the home for $600,000 and they did some substantial improvements to it. They did a massive remodel to it. Maybe they built a mother-in-law apartment. Maybe they added on an addition to the house. How does that fit into all this? In the last scenario, I told you there are time restrictions, those 2-year seasoning requirements. If there are substantial improvements, then the seasoning requirements really loosen up. So with that in place, improve the home, they have 25% equity, then there's no seasoning requirement with Fannie Mae. But if their loan happens to be with Freddie Mac, it's only 20%. So that's a big deal. So if you're working with a good loan officer and you know that you're buying this home, you're going to do a remodel to it, and that you'll have PMI, your loan officer hopefully is smart enough to take you to a Freddie Mac loan rather than Fannie Mae, because that just means it will be that much sooner before you get your PMI removed. So does an appraisal have to be done? Yes, it still does. And you have to be able to show the invoices, the work that's been done that have created those substantial improvements. And then part of that, you'll be able to have the lender remove the private mortgage insurance. So that being said, if it's been over 2 years and there's been substantial improvements, then either Fannie or Freddie, the minimum is 20% equity at that point. And I think I mentioned an appraisal is required on there. So let's walk through an example on this last one just to put the numbers home here. Home purchase, $600,000, same 5% down payment. Loan balance March of 2023 is $550,000. So they've paid down $20,000 over the past little bit. And they haven't been in the loan for over 2 years. Okay. Their loan officer was super smart and put them into a Freddie Mac loan. Okay. And then they did a massive remodel, right? They built an addition. They redid the kitchen. So the home is just in tip-top shape, and it should appraise for over $700,000. Okay, let's go through our checks and see if it's going to work. So do we have 20% equity, or the loan to value is less than 80%? Appraisal gets done by the current servicer, and yes, it does. So it's over $700,000. We have that 20% equity. Is it a Freddie Mac loan? Yes, it is. So then, therefore, my client can request from the servicer to drop the private mortgage insurance. Let me know if you have any questions on this. We are always happy to help, but some of the key points that if you're trying to take advantage of the appreciation in your home, remember 2 years is the minimum, okay? 20% equity is the magical number, unless you've done some massive remodeling and substantial improvements to the home. Work with a licensed and expert loan officer on this, and they can help guide you through it. Thanks for watching the video. Have a great week.